Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the couple of disclaimers, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that decrease or increase in importance over time. Yeah, that's the general objectives of the webinar. Our goal is to break down all the market jargon and complexities actually that you read about. So if you do have any questions as well, please do ask them along the way in the chat box, and we'll be happy to try and answer those as we go, or at least at the end of the webinar. Any questions, of course, that we're talking about or that you're looking at, any setups, anything we're talking about as well, please do ask any questions. More than happy to try and answer those as we go. Let's get into the webinar then. It's just after 11 a.m. in London. Yeah, here are the main topics that we'll go through in the next 30 minutes or so. We'll just check out how markets are trading currently. Then we'll just check out some of these themes that are popping up actually at the moment. We'll go through, summer markets and the VIX, the volatility index. It's Wall Street's fear gauge, if you like. And then we'll just look at some of the Mag 7 earnings and their growing again market cap around the S&P 500. We'll then get into the chunk of the webinar, which is reviewing all these main risk events that we have seen recently. Obviously, US inflation data this week we got yesterday, also the RBA meeting, and then we did have a Bank of England meeting, which has implications for sterling as well. So we'll look at the dollar index, we'll look at Aussie dollar, we'll look at cable sterling against the dollar in amongst whilst we talk about those risk events. And then we do have a couple of events coming up actually later on in the week, including some Aussie jobs, UK GDP, and US retail sales. We'll briefly run through that if we get time, but all the while looking at those major currency pairs. And I should say in section 2, if you like, we'll be looking at US stock indices. Okay, first up, really just where markets are trading currently. APAC stocks actually mostly finished higher as the region really took impetus from those record high closes on the S&P 500 and NASDAQ. Stateside, of course, we had words from US Treasury Secretary Bessent. He said probably need months, if not a year, of progress on fentanyl flows actually before Chinese tariffs will come down. He also stated the Fed should think about a 50 basis point rate cut in September. And that really is ramping up now, that pressure again for that September meeting in a few weeks' time. European equities in positive territory. That comes after gains, small gains on Tuesday actually in the Euro Stoxx 50, up 0.1%. Dollar had stabilized overnight, but now is seeing some selling pressure really. Euro dollar up above 117 again now, and cable, that sterling against the dollar, has reclaimed 135. Just a couple of themes then. First up is this VIX that we talked about. Interesting that in the middle of August now that we are, is generally sort of viewed as one of the dullest periods of the year. Basically everybody's on holiday, or a lot of people on holiday, lawmakers, central bankers, of course traders on big trading desks take a break. There's no real sort of big data points as such now, and that sort of means that we have thinner liquidity. But the one problem is that August actually is when volatility has a habit of exploding. Last year was a case in point, if you remember. Breakdown in the potential carry trade in the yen, we had a sharp appreciation basically of the Japanese yen combined with a big drop in US tech stocks, and that ignited one of the biggest one-day bursts actually in volatility on record. You can see from this chart that the average daily percentage move in the VIX, which just for your memory, reminding you again, is basically the CBOE, is a volatility index, which is basically real-time. It's a real-time market, sorry, representing well, market expectations for volatility over the coming 30 days in S&P 500 options. And this bar chart really is saying that August, over the last 35 years, yeah, volatility is the highest for any month, 0.56%. The least volatile month is April, you can see there, 0.07%, and that's even with this year's meltdown, of course, that we saw after President Trump's announcement on Liberation Day. So just be mindful of this. As I say, thinner liquidity can see quite sharp price action one way or the other, with not too much reasoning sometimes before then everyone comes back to their desks again for September and kicks on from there. So yeah, can be quite a volatile month historically, but we haven't just seen that as yet. Otherwise, we just want to talk about Mag 7, of course, those stocks post earnings really. Just got another chart here. Sorry, bear with me 1 second. Yeah, another chart here that you can see, just really showing you how Mag 7 earnings growth certainly has smashed every other stock really. You can see the left-hand bar, if you like, compared to that right-hand bar, and you can just see how much more earnings growth there's been for the Mag 7. Obviously, this is from 2023 up to then Q2 25, even then more than double, and then even though that's lessening going forward, you can just see how that has transpired really, and then moved obviously the stock index. At the moment, I think it's around a third of the S&P 500 market cap is taken up with the Mag 7, 32% or so. 23% of aggregate forward earnings are catered for by the Mag 7, and 12% of aggregate forward revenues. So again, breadth is very narrow. That's what's pushing really the major stock indices higher, the S&P 500 and the NASDAQ, of course, tech heavy, and then with the Mag 7 really boosting stocks higher. Interesting, in amongst the Mag 7 even, there is quite a difference as well. If you think of MNM, so Microsoft, Nvidia, Meta, those are the stocks which are clearly positive year to date. I think Nvidia around 36% or so, Microsoft 24%, Meta around 30%. So heavily weighted to those currencies really, performance in the Mag 7, whereas you think about Alphabet, Google around 6% I think up year to date, Amazon barely in the green, I think up about 1.5%, and then of course Apple, Tesla in negative territory year to date. So Apple around down 8% and Tesla down around 18% year to date. So even amongst the Mag 7 there is this divergence as well. So just again, be wary of that. I know a lot of people talked about the breadth being an issue, but of course it's only an issue when it kind of is an issue. So yeah, very bullish sentiment it seems in stock markets at the moment, and yeah, record highs being seen. Of course, 16th I think record high for the year in the S&P 500. Nvidia now the highest market cap of any stock ever, I think now, was one headline I saw. And it's just whether we get some of this exuberance just sort of being reined in slightly, possibly on well, rate cut, but we still are still going ahead for September, which we'll get to. For the Fed, AI, of course, boosting and underpinning all of this bullish rally, but possibly as well, just thinking ahead, stagflation issues, possibly if inflation does pick up, but at the moment it isn't, and we'll get to that shortly. Okay, just those couple of themes really going on. In amongst that, I should say we have had some Trump nominations, of course, for the Fed, and also the BLS out overnight, actually. Firstly, that Fed nomination, Stephen Mirren, for a temporary position, let's not forget, until end of January next year. He's filling in the remaining term that was vacated recently. He basically has expressed skepticism about the Fed's independence, argued for stronger presidential control over the Fed board. He's known as a dove, a proponent of a weaker dollar, well, on his announcement, actually nomination, we did see a modest decline in the dollar, but nothing too major. Obviously, we're getting that today and this week, really. But really, that's just a potential alignment with Trump's push for, of course, looser monetary policy. Then I said overnight, we've got Trump's choice to head the BLS. That's basically the government agency which produces economic statistics like non-farm payrolls, like CPI. He has said basically he's considering switching from monthly payroll reports to quarterly payroll reports during a methodology review period. I think he's called some of the revisions that we've seen over the last few years baloney. I think it was one quote from X that he mentioned, and sort of a random number generator. I think he called it one month as well. It's kind of hard to gauge exactly how seriously markets are taking the threat of a sort of quarterly payrolls report than, say, a monthly payrolls report. That reaction had been muted on the announcement, but now we are seeing some downside in the dollar. Certainly, if the BLS got the go-ahead with that frequency change to quarterly report, then you would see the dollar get hit very or pretty hard on that confirmation at all. It's only speculation at the moment, I should say. Okay, I said we just look at some of the stock indices. Obviously, they've hit record highs, so there's not too much to say about them really. I just first of all got a VIX chart here that you can see that volatility index again. You can just see that push higher, start of August actually. And then if we go back, you can remember that rampant, that huge spike high that I mentioned last August. Nothing like that at the moment. A short spike above 20. Long-term average of the VIX, I think, is around 17, 18, but we've been around sort of 15, 16 more recently. So yeah, that's where we are now, below 15. But yeah, just historically can get interesting in August. If I just pull up some of those stock charts as well, not too much to say really. The S&P 500 chart still in this bull channel. I've extended that actually because it was a bit narrow and we dropped out of it actually on that August low print, but now edging high. You can see bullish momentum and yeah, taking out those record highs. Same in the NASDAQ really. I've got that previous high at 23,573, broke through that in a strong close yesterday, not even overbought at all, so should see more record highs really. The Dow not quite reached that record high, just above 45,000, but does look quite bullish if we can break that last week's high, just below 44,500. If we do, then yeah, 45,000, here we come. It looks like with decent bullish momentum as well. Okay, let's move on now to, well, the most recent risk events, of course, and their implications for markets. First of all, we had US CPI data yesterday. Interesting, really came in largely as expected, really headline rising 0.2% month on month, 2.7 year on year. That was slightly below the 2.8 estimate. And then the core, more important, strips out food and energy, which are volatile generally. That rose 0.3% month on month, 3.1% year on year. That was actually a tenth hotter than the 3% estimate. These were the figures just before we got those prints that you can see. Really then, the details actually, energy prices fell 1.1% month on month. Food was flat on the month. But it was really all about tariffs, of course. So in terms of the sectors most exposed to tariffs, things looked, well, pretty benign actually. So the focus was on core goods ex autos. They rose just 0.2% month on month after jumping 0.55 month on month. And here's a chart there. You can just see that 0.55 print and then back to the 0.2 print. So that was a relief to many. And it kind of suggests actually for now, at least, corporates are absorbing most of the tariff cost. And as I say, that alleviated all those market concerns of a sort of more rapid pass-through, if you like. That was a number, yes, that had been looked at because of that spike. You can just see the year-on-year moving higher, but that month-on-month kind of being a spike, and we're back down to sort of more average levels. Yeah, so that's the core goods ex autos number. Also, Fed Chair Powell has said he's started looking at the super core number, just for your guide. So that's core services minus shelter. And that did actually rise to 3.2% from 2.7%. So just watch out for that. Going forward, well, the ISM price components, they still suggest there could be lingering inflation and that threat from tariffs. We did get a survey yesterday, an FIB sort of business survey, that suggests small businesses are kind of struggling to pass those costs on to consumers. But many prices will end up rising in time due to tariffs. That's what they are, a consumption tax essentially, even if many economists don't see the sort of inflation pressures persisting. That is that idea around it's the fact that it's a one-off price move, if you like, but then isn't sort of persistent. Against that, of course, we do have cooling housing rents, cooling wage and energy costs as well. They're really expected, most economists think, to offset the tariff effects over the coming months and quarters even. And along with, of course, we've had GDP forecasts being cut from 2.5% at the start of the year now to around 1.5%. Then it all kind of leads to a September Fed rate cut, and that is what is priced by markets. Just to note, there is one more CPI report in September. That is the week before the Fed meeting. So the CPI report on the Thursday, the 11th, I think, and then the Fed meeting the following Tuesday. The following Tuesday, Wednesday, so middle of September there. And just as again for your guide for PCE implications, that's figure Fed's favored inflation gauge, of course, which we normally get at the end of the month. Most economists, or some economists, I think they reckon the CPI figure is now consistent with a sort of 0.23 increase in core PCE, which again wouldn't trouble the Fed and officials there before obviously that September meeting, although we do get one more report. So really interesting actually whether we do get any kind of move higher in CPI the week before the Fed, and then what happens with that decision. And I also think we're in the blackout period actually from the 7th of September, so would be really interesting. That CPI report will be really big to either confirm, of course, a September Fed rate cut if numbers are in line around 0.2, 0.3% for the core, but obviously higher than that then would be an issue for the Fed, and also the fact that they would have to try and communicate what they were thinking ahead then of the Fed meeting, even though they're in the blackout period, and would have to use possibly people in the press. So we shall see. That is all speculation, but yeah, very interesting few weeks coming up for sure. Moving on to actually before we get to the RBA, let's just look at the DXY chart. So this is, of course, the dollar index chart against 6 of its main trading partners, with the euro being by far the biggest weighting in this index, around 56% or so. You can just see then recent multi-year low from the start of July is at 96.37. We sort of broke out of this bear channel a little bit and got up to, well, 99.57, which was a swing low from back in 2023 there, and also a minor fib level of this move down, 99.63. So sort of resistance zones there. We got up to it, failed, and then we've broken down back And interesting, the blue line is the 50-day moving average, which has acted as resistance. We broke through it briefly, traded around it, but now looks like we're breaking down again, back down below it. That's at 98.13 for your guide, the 50-day moving average. And then we've got obviously that low at 96.37 with those swing lows from late July around 97.10. So that's a dollar index. Just for your guide, that dotted line, big, thicker dotted line, if you like. Look on the monthly. It's a very long-term upward trend line. You can see tapped 2011 lows, 2021 lows, and then obviously these lows, which we had in July. So just we're keeping that on there just for a guide as well. Okay, moving on to the RBA meeting just briefly. You can see on the chart here, these are market expectations for what happens in the future to RBA and the policy rate. Of course, they cut rates by 25 basis points to 3.6% as expected. That brings cumulative easing now to 75 basis points. Basically, they said inflation has continued to moderate. And with updated staff forecasts suggesting underlying inflation will continue to hover around the midpoint of their 2 to 3 target range, that is assuming an extension of the current gradual easing path, which you can see here. Terminal rate then will potentially be around just above 3%. The RBA, just for your guide, in their statement, they judge that there is still a risk of households and firms delaying expenditure pending greater clarity on the outlook, even though the worst trade outcomes have been avoided. They're essentially downward revisions to inflation and growth by the RBA. Markets saw that as a dovish signal. Should say though, Governor Bullock did keep forward guidance open-ended and data dependent. Basically, the board remains cautious about the outlook. There's a high level of uncertainty, but of course they do what they consider necessary to achieve the dual mandate, which they have, of course, of price stability and maximum employment. Money markets didn't change too much. They still see or assume 2 more rate cuts for this year. That's at a quarterly pace, essentially. And as I say, bringing down the policy rate to a terminal rate of around 3.1% by February next year, touch lower potentially that markets are seeing, but around the 3% mark that you can see there. Nothing major really in the market reaction. If we just pull up the Aussie dollar chart, you can just see, yeah, not a big major reaction yesterday. Dipped lower, but then yeah, dip lower, just looking when that dip was, but then buyers stepped in really on the risk sentiments being pretty positive and buoyant. Again, we've got sort of these recent highs just above 66.25 at the end of July, but that sort of 66 area looks like a resistance zone. You've also got some Fibonacci levels, one here now, 65.49, that's a 61.8 retrace level of this move lower. And then you've got support around the halfway point of that move, that's at 64.27. Blue line there is 50-day moving average at 65.18, then the black just below that halfway point is the 200-day moving average at 63.88. Okay, also, of course, then we had the Bank of England meeting, just to recap on that from last week. Just quickly, they cut rates obviously by 25 basis points to 4% for the base rate, level last seen in March 2023. Really interesting meeting actually, because it was the first time ever the MPC was required to vote for a second time after a 3-way split in the first vote. Never seen that before. Really many sort of casting quizzical look about what members are doing, really. That very well, exceptionally an exceptional event, really. The first vote saw 4 members voting to leave policy unchanged, 4 for a 25 basis point cut and 1 for a 50 basis point cut. Then they had the second vote, 5 members wanting to ease policy coalesced around a 25 basis point cut, creating that majority. Basically, the minutes of the meeting revealed that those favouring a cut were mostly concerned by disinflationary pressures from emerging slack in the labour markets, which we didn't see so much of with the data this week. But we have seen underlying wage growth moderating slightly. But then the 4 members in the minority, they emphasized that following a recent increase in headline inflation, they said the disinflationary process had slowed and the risk of inflation expectations feeding through to second round effects had risen. So really quite different views here on the MPC. The updated Bank of England projection for CPI, that was really interesting because that basically illustrated a view of the latter group, which was in the minority. So headline inflation now is expected to peak at 4% in September. That's 0.3 percentage points higher than the Bank of England estimated 3 months ago. And you could just see, yeah, CPI headline then expected to go to 4%, and you just got the core as well, and then services still relatively sticky. The services anyway around 4.7% at the moment. Just on those projections, they do then think actually that, I should say, CPI will return to the 2% target 1 quarter later. GDP projections, they were little changed, consistent with a gradual recovery. And then in the press conference, well, Governor Bailey admitted that while the policy rate remains on a downward trajectory, the monetary policy path has become more uncertain. And obviously they're trying to balance up this issue, the big issue they have, upside inflation risks versus downside risks on economic activity and the labour market. They did, though, maintain forward guidance of a gradual and careful approach to the further withdrawal of monetary policy restraint. Markets, well, they moved quite unsurprisingly, quite sharply after this surprising hawkish cut, if you like, that we did see. So bets on a 25 basis point another cut were pretty much priced out for the year, were priced in for November really, and the touch before that as well. Now I think it's less than 50-50 November, and the first fully the next first full 25 basis point cut isn't seen till February next year, I think. So yeah, interesting meeting really, and the different viewpoint coming out of some on the MPC, and that's what markets are watching, even though it is very split. If we look at the cable chart, you can just see that big boost now as rate cuts have been reined in, essentially. The BoE, of course, was on the 7th here, and you can just see sort of propelled this bullish move higher on the back of a weaker dollar, and of course then those reining in of rate cut bets by the Bank of England, contrasting with, of course, Fed rate cut easing, getting increasingly priced in. So what happens to the currency? Sterling goes up, of course, dollar goes down, cable goes up. You can just see we've broken out of this sort of very short-term, narrow, descending channel, if you like. Only a very short-term one, it looks like. You've got the 50-day moving average, that's at 134.98, so we've broken above that now. And obviously we have these swing highs from late July around 135.84, 135.88, just possible initial resistance, and then you've obviously got that multi-year high now at 137.84. I should say we did have that jobs data as well out on Tuesday this week. The employment change actually surprised to the upside, reaching its highest level since September. And the data really probably offers support to that recent shift in rate expectations for the Bank of England. Obviously with the vote split, as we've said, suggesting real fragmentation really in the market's broad consensus for further easing, and that's what we're seeing now, that getting reined in, and cable going and sterling going higher. One other currency pair that I know is popular, sterling against the yen, we look at that and it's really at an interesting point. You can just see resistance from previous highs in October last year, and then these highs from July around 199.70, and just above there 199.97, that July high, and we're just moving above it now. So interesting, with 7 days now consecutive buying in sterling against the yen. If we just pull it this wider angle, then quite an important resistance level. If we can break through here, then obviously you've got probably round numbers then 200 and plus, with that long-term high from July last year at what, 208.12. If we can break through this, then yeah, round numbers for sure ahead of that very long-term high. Let's pull it back to the monthly, and it is an exceptionally long-term high going back to 2008. So yeah, that's the monthly chart. And really, we're kind of staying in this bullish channel, aren't we? We did pop out of it for a few months last year, but really I should extend that now. Just bear with me because I'm not. Yeah, something like that. Which means we're bang in the middle of this bull channel and we're going to go higher. So yeah, interesting chart, which we are looking at quite closely with that sort of level around 200, just below 200 sterling yen. Don't look at that often, but yeah, we thought we should highlight that as an interesting chart. Okay, just quickly, just data for this week then. Just a few random bits of data really. We do get UK GDP data, and in fact I was going to pull up euro against the sterling for this, so just bear with me again. So here's euro sterling. Yeah, Thursday sees June month-on-month GDP. That's expected out of the UK to print at 0.1%, so positive after the negative 0.1% reading last time. That means Q on Q would be around 0.1% from that 0.7% first quarter. Big growth number really, but of course that was boosted by front-loading exports ahead of US tariffs, of course. But potentially annual growth could be a touch higher than the OBR's estimate of 1%. So that's UK GDP on Thursday. Euro sterling, I'm just showing you this chart, highly dependent on UK data really at the moment. We are seeing it move lower and having found resistance again around that sort of 87.50 mark. We then have moved lower for 5 consecutive days now. We did dip below that first Fibonacci level 86.31, but then pulled back yesterday. So that'll be an interesting level of support. Then you've got the 50-day, which tallies with these July lows. That's at 86, just above 86, 86.04. So that could be some support as well for euro sterling, but watch out for that because it's dependent on well, the pricing out of BoE cuts, of course, and a lot of data as well. Otherwise, yeah, we've got Aussie jobs. I should have touched upon that. Expectations for recovery in employment growth actually after pretty much flat prints in May and June. Employment growth, I think, expected around 25,000. Unemployment forecast at 4.2% after jumping up to 4.3% in June. And then we do get some Chinese data actually out on Friday. Don't look at dollar CNY very much, but here it is just for your guide. Yeah, there's a deluge really of data that they release on the same day. Economic activity in general probably expected to continue moderating with housing price weakness ongoing. So you've got industrial production that's likely to have slowed after a strong print in June. Retail sales forecast to slow as well as sort of policy impacts ease, and then fixed asset investment seen steady around 2.8%. Dollar CNH, this is actually, so you've got the 50-day moving average, the blue line, just acting as support at the moment around 717. If we do lose that, then obviously you've got this low here, which tallies with the 61.8 February chase level around 714.55, that is. Otherwise, if we do bounce off this support, then of course you've got the halfway point of this move, which is around 720, 719.31, and then you've got that high, August high really at 722 for your guide. Okay, I don't see any questions, so really hope that's been of use to you guys. I really do appreciate you being on the call. Yeah, hopefully that's been clear to you. Lots happening in the next few weeks ahead. I think Jackson Hole is something to look out for next week for sure. That's the Fed's annual symposium in Wyoming, potentially as sometimes featured a monetary policy shift by the Fed. So that'll be later next week. Then as we then get into sort of September with those key data points in the US ahead of the Fed meeting, of course. We'll speak to you in a couple of weeks' time, I think, actually, or maybe next week, actually. So look forward to that, and we'll speak to you then.